There is a number that the banking industry does not advertise. A number they have studied carefully. A number that shapes nearly every product they have ever designed, and every policy they have quietly written into the fine print of your account agreement. And that number is one. One unexpected bill. One job loss. One medical event. 1 month without income. That is the distance between where you stand right now and a financial crisis that would take years to recover from. And the institution holding your money has known this about you, statistically, with remarkable precision long before you sat down to read the terms and conditions you agreed to without reading. This is not an accusation. It is an observation. And the reason it matters, the reason it is worth spending the next 30 minutes sitting with, is not because the system is broken. It is because the system is working exactly as it was designed to work, and most people living inside it have no framework for understanding what that actually means for the decisions they make every single day. You were taught that money is about income and expenses. You were told that if you work hard enough, spend carefully enough, save consistently enough, you will eventually arrive at something called financial security. You have probably believed some version of this for most of your adult life, and yet the feeling of security, the actual felt sense that you could survive an emergency, that you are not one disruption away from real damage, remains just slightly out of reach, no matter how many times you reorganize your budget or tell yourself things will be different next month. What if the distance between you and that feeling is not a personal failure? What if the architecture of the financial system is specifically designed to keep that distance precisely where it is? That is the question this video exists to explore. Not to frighten you, not to make you angry, not to sell you a course or a product or a philosophy. Simply to look at what is actually happening, clearly, without sentiment, the way you might look at a machine whose function you are only beginning to understand. Picture an ordinary Tuesday. You wake up at roughly the same time you always do, and somewhere in the first few minutes of consciousness, before you have fully decided to be awake, your mind runs a quiet background calculation. A habit so old and so automatic that you stopped noticing it years ago. It is a rough, approximate sense of where you stand financially. Not a number exactly, more of a feeling, a temperature, something between fine and not fine, updating itself slightly based on what you remember spending this week, what bills are due, whether the month feels heavy or light. You check your phone. You see your balance. The number is either slightly better or slightly worse than you expected, and you feel a corresponding flicker of either relief or low-grade tension, and then you put the phone down and move on with your morning, because there is nothing to be done about it right now, and the coffee is not going to make itself. This is the first financial decision of your day, and you did not consciously make it. You simply felt it and moved on. At some point during the morning, you buy something small, coffee, a sandwich, something for the commute, and you tap your card without really thinking about it, because the amount is small enough that it does not register as a decision, it registers as a reflex. And this is true for dozens of small transactions each week that do not feel like choices, because they fall below the threshold of what your brain has classified as worth deliberating over. In the afternoon, you receive some kind of financial communication, a bill, a statement, a promotional offer from a credit card company, a reminder about a subscription you forgot you had. You look at it long enough to determine that it does not require immediate action, and then you set it aside, because dealing with it properly would require a kind of sustained attention that the day has not left you with. You tell yourself you will look at it properly later, this weekend, when you have more time and more mental space. You have said this before, you will say it again. In the evening, there is a moment, maybe after dinner, maybe in the hour before sleep, when the financial temperature returns. The background calculation runs again, the rough sense of where you stand. And sometimes, in that quieter space, the number feels more fragile than it did in the morning. You think about the emergency fund you meant to build. You think about the raise you were going to ask for. You think about the credit card balance that has been sitting at roughly the same number for 8 months, neither growing nor shrinking in any meaningful way, because every month you pay enough to stay current, but not enough to actually reduce the principal by anything significant. And then you go to sleep, because there is nothing to be done about it tonight, and tomorrow the cycle begins again. This is not a story about irresponsibility. This is not a story about a lack of discipline or a failure of willpower. This is a story about a person living inside a system that was built with a sophisticated understanding of exactly this kind of day and designed with considerable care to produce exactly this kind of equilibrium. Here is the behavior. Every month, you make the minimum payment on your credit card. Or perhaps not the minimum exactly. Perhaps you pay a little more than the minimum, because paying the bare minimum feels reckless and paying more than the minimum feels responsible. And the distinction is important to you, even if the difference in the actual amount is $40 or $50. You pay what feels like a reasonable amount. You feel, briefly, like you are managing things. And then the next month arrives, and the balance is still essentially the same number, waiting for you. Now here is the psychological need underneath that behavior. What you are actually purchasing every month when you make that payment is not debt reduction. You are purchasing the feeling of being in control.
You are purchasing the temporary relief of having done the responsible thing, of having addressed the problem, of being a person who manages their obligations rather than ignoring them. The payment is not primarily a financial transaction. It is an emotional one. It is the price you pay for 1 month of feeling like you are handling it. And the banking system, the credit industry specifically, understood this need with extraordinary precision long before you were ever handed your first card. The minimum payment structure was not designed by accident. The fact that there is always a number that feels manageable, always a payment threshold that is achievable without real sacrifice, always a way to feel like you met your obligation without actually reducing your exposure. This is not a feature added for your convenience. It is a mechanism engineered around the specific psychological need you have to feel like you are in control of your finances without having to experience the discomfort of actually restructuring them. They gave you a way to feel responsible because feeling responsible is what you needed, and feeling responsible is far more profitable to them than you actually being debt-free. And here is the reversal that sits beneath even that observation. The feeling of control you are buying every month with that payment is manufactured scarcity. They create the anxiety through the existence of the debt itself, through the late payment warnings, through the credit score implications, and then they sell you the relief in the form of a payment structure that extends your relationship with them for as long as possible while keeping you feeling just managed enough to not take dramatic action. You are not failing to pay off your debt because you lack discipline. You are doing precisely what the emotional architecture of the product was designed to produce. To understand why this is, it helps to understand something about what a bank actually is, not in the legal or technical sense, but in terms of what it is actually optimized to do. A bank is a machine for converting uncertainty into predictable revenue. That is its core function. Not storing your money, not providing security, not helping you build wealth, though it may do some version of those things incidentally. Its primary function is to find people in states of financial uncertainty and create products that generate consistent long-term income from that uncertainty. The most valuable customer a bank has is not the wealthy one. The wealthy customer does not need the bank's products the way the system needs them to. The wealthy customer has options, negotiating power, the ability to move their money without consequence. The most valuable customer in terms of long-term revenue generation is the person who is financially close enough to stability that they can meet their obligations every month, but uncertain enough that they will carry a balance, pay interest consistently, and never fully exit the relationship. This is sometimes called the near-miss customer, the person who is almost fine, the person who is one emergency from real trouble, but not in so much trouble that they default, because a customer in default generates losses, and losses are not the point. The point is a customer who pays and pays and pays reliably, in perpetuity, without the situation ever resolving in their favor. The credit scoring system is one of the most elegant instruments ever built for identifying and managing this category of person. Your credit score is not a measure of your financial health, it is a measure of your usefulness to the lending system. A person with no debt and substantial savings can have a lower credit score than a person carrying multiple active credit accounts, because the credit score is measuring engagement with borrowing, not financial well-being. The person with no debt is less legible to the system. The person with multiple accounts, paying reliably, carrying balances, that person has a rich data profile, a demonstrated relationship with managed debt, a predictable pattern of behavior that makes them an attractive candidate for more products. The anxiety that lives in the gap between your income and your sense of security is not a side effect of the financial system. It is an input to it. The industry has a term, financial stress, and they study it with the same care that a biologist studies an ecosystem, because financially stressed people make predictable decisions, and predictability is what the product is built on. When you are stressed, you are more likely to carry a balance rather than pay it off. You are more likely to accept a slightly worse interest rate rather than spend the cognitive energy shopping for a better one. You are more likely to opt into an overdraft protection fee because the alternative, the overdraft itself, is more frightening in the moment than the fee. You are more likely to make the minimum payment, feel the brief relief, and not examine the math of how long that minimum payment will take to actually resolve. Stress narrows attention. Narrow attention is commercially useful. This is not malice. It does not require anyone in the industry to be sitting in a room laughing at you. It requires only that the incentive structures reward certain product designs over others, and that over decades of refinement, the products that remain are the ones most effective at generating sustained engagement from people living in a state of managed uncertainty. The system is not broken. It is optimized, and it is optimized for a version of you that is always almost but never quite free. There is a moment, and perhaps you have had some version of it, though it tends to pass quickly, when the logic of something you have been living inside becomes briefly completely visible. Not frightening, not enraging, simply visible. You are looking at a bank advertisement, and for the first time you do not hear the words. You see the structure. You see the warm imagery and the language of partnership and the carefully chosen faces of people who look like they're in the demographic the ad is targeting. You see that the product being advertised, the loan, the line of credit, the card with the introductory rate, is described entirely in terms of what it gives you and never in terms of what it costs you over time.
And you realize that this is not an accident of marketing.
Introductory rate is real. The benefit is real. The low monthly payment is real.
What is not said, what is structurally absent from every advertisement for a credit product you have ever seen, is the shape of your relationship with that product 18 months from now, 36 months from now, when the rate has adjusted and the balance has barely moved, and you are still making payments on something you purchased so long ago you can barely remember what it was. The advertisement is not lying to you. It is simply choosing, with great precision, where the frame begins and where the frame ends. And once you can see the frame, you cannot entirely stop seeing it. You begin to notice that every product in the financial space has this quality: a carefully constructed foreground and a carefully managed background. the savings account with the promotional interest rate that reverts after 90 days, the insurance product bundled with a mortgage that covers the bank's risk more than yours, the overdraft protection that protects you from a $35 fee by charging you a $35 fee, the rewards card that gives you points for spending and charges you interest for not paying off what you spent, converting your own purchasing behavior into a cycle that generates revenue on both ends. None of this requires deception in the legal sense. It requires only that the industry understood earlier and more deeply than most people think about that human beings do not process information, they process feeling. And if you can construct a financial product that feels like safety, feels like reward, feels like responsible behavior, the actual mathematics of the transaction becomes secondary to the emotional experience of engaging with it. You were not taught to look for the frame. You were taught to look at what was inside it. And that, as much as any interest rate or fee structure, is how the system sustains itself across generations of customers who consider themselves financially responsible and who are, in every technical sense, correct. They are responsible. They are meeting their obligations. They are doing what the system asked them to do. They are simply not aware that the system asked. Here is what this observation does not mean. It does not mean that you have been victimized in a way that demands outrage or retaliation. It does not mean the solution is to withdraw from the financial system, to keep cash under a mattress, to distrust every institution that has ever processed a transaction for you. The system is real. Its products are sometimes genuinely useful, and the people who work within it are, for the most part, not conscious participants in anything. They are doing their jobs inside structures they did not design and do not question, the same way most people inhabit most systems. What this observation does mean, the only thing it actually changes, if it changes anything, is the quality of your attention. There is a difference between making a financial decision inside a system you cannot see and making the same decision inside a system you can see. The decision may be identical, the transaction may be identical, the outcome in purely numerical terms may be identical, but the person making the decision has changed in some small, irreversible way. They are no longer surprised by the frame. They have stopped waiting for the financial system to hand them a moment of genuine security as a reward for compliance, because they understand now that the security they feel, that particular flavor of almost fine, is a feature, not a malfunction. It is the emotional state the product was designed to produce. It is renewable, manageable, and commercially durable in a way that genuine financial independence is not. This is not a call to action. There is no 10-step plan at the end of this sentence. There is only the recognition that the most powerful thing the system has over you is not the interest rate. It is the assumption that the system is neutral, that it is simply infrastructure, like roads or water pipes, processing your money without intention. Once that assumption is gone, you are still inside the system, still using its products, still subject to its logic, but you are inside it differently. You are inside it the way someone who understands the rules of a game is inside it, not free from the game, but no longer confused about what game is being played. The emergency fund you have not built is real. The balance you have been carrying for 8 months is real. The gap between your income and your sense of security is real, and it will require real, patient, unglamorous work to close. But you do not have to close it while believing that the gap is your fault. The gap was designed. The anxiety is a product. The feeling of almost fine is the deliverable. And knowing that, simply knowing it, sitting with it, letting it become part of how you see the financial decisions in front of you, is the beginning of something quieter and more durable than anything the system was built to sell you. It does not have a name yet, this thing, but it feels unmistakably like clarity. If you stayed through to the end of this, something in it held your attention long enough to matter, and that's worth something, because most content designed around money is designed to make you feel either inspired or afraid, and neither of those states is particularly useful for thinking clearly. If what you heard here opened something for you, the next video in this series continues looking at the structures underneath ordinary financial life, the ones that operate quietly, without announcement, in the background of decisions you think you are making freely. You can subscribe if that kind of thinking is useful to you. There is no pressure, no countdown, nothing being sold. And if something in this video landed differently for you, if there is a moment that hit closer to home than you expected, the comment section is below. Not to perform financial wisdom at each other, but simply to say, I see this too. Because sometimes that is the most honest thing two people in the same system can say to one another. Thank you for watching.